Hello there, this is Bob, and I'm going to be taking 230 into a test review now, chapter 6, 7, 8. Hopefully you've had a pretty good amount of time to study the materials in them, starting with chapter 6, which is all about cash and accounts receivable. Chapter 7, cost of goods sold, LIFO, FIFO, a few other things. And then chapter 8 about depreciation. So let's see, we have somebody coming in here. Hi, Brianna.
Hi, sorry.
Oh, that's okay. It's just me and you. Yeah, if you don't mind, leave your face up there because you and I are going to be talking as we go through this. Okay.
Okay.
I mean, if you have to shut it down, that's okay. But let's go through it. I was just starting to announce to everybody that we're going to have a test review now. And the last time you and I did a test prep together, we went through a sample of a test. Would you like to do that?
Yeah, that's fine. I haven't studied as much for this one, so I may not be much help, but I just want to keep reviewing.
Okay. Well, let's go through the review then. I'm going to go into the PowerPoints a little bit then. Okay. Come on, PowerPoints. Okay, I must share. Share. Now this thing is giving me a hard time. Why can't I share? Oh, here we go. See the PowerPoint now?
Yes.
Okay. Let me just move this out of the way. We can get started here. Okay. All right, chapter 6. I'm just going to highlight things, okay? And here we go. Okay. What do we have here of great interest, okay? We have the contra revenue accounts, right? You never debit sales. Never debit sales. But we have to reduce the gross sales via these contra sales accounts. These are contra sales accounts, like all contra accounts. They're married to a big somebody other. And in this case, they're married to the sales. So gross sales minus these three things: sales discounts, sales returns, and credit cards, which is not on here. Credit card fees will reduce the gross sales to net sales. We talk about the components: sales discounts. We know how to read this now, huh? 2% 10, net 30. You get a 2% discount if you pay in 10 days, net in 30. I don't expect anybody to have a problem with that. But this, I think, is interesting. If you find somebody willing to give you 2% interest in just 20 days, you'd be crazy not to take it, because 2% means you're getting it not every year, but every 20 days. You divide those 20 days into a year, 365, and then multiply it by the percentage, which in this case is 204. You're really getting 37.5%. So a 2% discount in these markets today is a fantastic deal. Sales, returns, and allowances, contra revenue account. People return things to the stores. Net sales, simple template here. You're going to get questions on the test maybe where they say the sales were this and the sales discounts were this, sales returns and allowances, and these were the net sales. How would you get the credit card discounts? So this should be right in everybody's skull right now, and I don't think that's a big problem. Sales minus your three contra accounts. Okay, I just need to move something out of my way here. Okay. Trade receivables and accounts receivable are the same thing. Trade receivables and accounts receivable, same thing. Non-trade receivables would be maybe you loan money to an employee, like we used to do a lot where I worked, or you loaned money to somebody and they owe you interest, okay? Trade receivables. Okay, here we go. Bad debts. Bad debts. We must recognize bad debts expense at the end of the month. Bad debts expense is an adjusting journal entry done at month end. It is done by either reviewing your sales for the current month or looking at your aging of accounts receivable. The journal entry is always going to be the same in terms of the accounts. So take a look at this, everybody. Look at that journal entry. Bad debt expense debit. What is the only account you can possibly credit when you're debiting bad debt expense? It's the allowance. It's the allowance. So if you're looking at a T account of the allowance and you see a credit, you know the debit was the bad debt expense. So this entry is always the same. Debit, bad debt expense, credit, allowance for doubtful accounts, which is another contra receivable account, okay? How come I can never get my head in the middle of the screen for some reason? Okay. Yep. Question?
Yeah, so like that's the when you are estimating expenses. So when
Yes.
you want to just do that, can you do the expense right away without estimating?
No, you
And then
don't.
does it just no?
No, you see, when you write somebody off next month, that came from sales maybe from this month. In other words, you have to have a reasonable bad debt expense on your income statement based on your history and expectations. So it is an estimate. When you know who the person is that went bankrupt, that's when you write that person off. And that entry can be done every day. Hopefully you don't have a million of those people, but so
Right.
Here all we're doing is we're matching up our expenses to our revenues by saying we have bad debt expense. And let's take a look here. Accounts receivable minus the allowance gives you net receivables, okay? That's the amount the company expects to collect. They billed out, say, $1 million to customers, but they don't expect to collect, say, 3% of those. So that's $30,000 they're expecting to lose. Now here's the second journal entry, and there's only a pair of two-line journal entries in regard to the world of the allowance for doubtful accounts. And that is when we know who the bad guy is, when we know the guy's not going to pay us, look at the journal entry. Now we're debiting that allowance. That allowance was money that we set aside to reduce AR when we know who comes off the aging. We found out that this customer, he owes us $6 million, almost $7 million, is not going to pay us. We know he's not going to pay us. We saw the guy get arrested on the news yesterday or something like that. So now we use the allowance. And notice it's a debit to the allowance and a credit to accounts receivable. Think of that T account I was talking about. If you see a debit to allowance for doubtful accounts, this is the only possible credit. Accounts receivable. Okay. Now here, they want to point this out. Here, before Deckers wrote off that big number, that's 7 million, they had 62 million in AR, 13 in the allowance. After they wrote this customer off, what happened to the net receivables? They did not change at all. And why is that? Because these are two receivable accounts we're just reclassing. Okay? A write-off affects nothing really. The only thing the write-off does visibly is now we take that person off of the aging and go from there. Okay. Now, estimating it. Now we probably, now they're going to show us how to figure it out, okay? The sales method, very easy. You multiply your sales for the current month times the percentage, and that's your bad debt expense. Kids clothes, credit sales is 600,000, right? We don't worry about cash sales. 600,000 credit sales, they expect to lose 1% or 6,000. What did we say the journal entry is? Well, we know, right? We debit bad debt expense, and we should know now what you credit the allowance for doubtful accounts, okay? Now, the AR method is the trickier one, but as long as you understand what number you're generating, it's not that tough, okay? The AR method's the better method. I'm sure the AR method is used all over the world and not the sales method, okay? I say that great certainty. Here, this method's better because you're starting all over again. You're looking at your aging, and you have a policy here that says, as the item ages out, as a person goes longer and longer without paying you, there's less likelihood he's going to pay you. So what this company has decided that people who aren't even due yet, we expect to lose 1%. But if they go 1 to 30 days past due, probably lose 4%, 10%. Look at this, all the way out to 40. Okay. So it's really simple to get the number, which is gotten by multiplying the total aging by the appropriate percentage and adding across. Now, here's the key difference that we have to understand. That 1201 is not the bad debt expense. Let's understand, everybody, that 1201 represents the balance that we want to have in the allowance at the end of the month. So here they're telling you that this account already had a credit balance of 50. We want to bump it up to 1201 based on our aging, and there's your journal entry. Okay, just do a few more of these and it should click. Just concentrate on what the journal entry is: bad debt expense, credit the allowance. And here, look at here's the T account. Whenever you see an item credited to the allowance, you know the debit is to bad debt expense. No exceptions. If you see a number here on the debit side, you know it's because you used the allowance to reduce accounts receivable. I'm going to skip this thing here. Okay, I don't think we need to spend too much time on these sales discounts. I think this is pretty easy. Somebody went in, they bought boots for $3,000. They used a credit card. Well, the credit card charges the shoe store 3%. So when we record the sale, we record it. Well, they're skipping ahead here. They're skipping ahead. We record the sale for $3,000, right? Oh, I remember this thing went out of order on me. Ooh, that's annoying. Okay. Sold something for $1,000. Discount 2%, 10. We'll work with this. You don't worry about the discount at the point of sale. It's when you receive the cash. So what happened here? Kookaburra, or our customer, owes us $1,000. So they paid that debt off, but they only needed to pay $980 because they paid within the 10-day period. If they pay after that, they're not entitled to take the discount. Sales returns and allowances, same thing. $500 boots, and they're given a sales return or allowance here. Here it is. Sales returns and allowances. You never debit sales. Never. but you reduce sales via the contra account, and we're going to credit accounts receivable because this person returned a $500 pair of boots. But we also must take the cost of those boots, put them back in the inventory, and credit cost of goods sold. So we're reversing, in other words, we're reversing the original entry when we sold it. The only difference is we're not going to debit sales because you just don't ever debit sales. Never. We know what cash is. Money orders, checks, like it says here, bank drafts, direct deposits, credit cards are cash, as far as I'm concerned, okay? Credit cards are cash. And you want to take care of your assets. And I'm not going to tell that long story again about the woman who stole hundreds of thousands of dollars from the police department because she was given too many responsibilities, which tempted her to steal. Bank reconciliations. Bank reconciliations. You're going to get questions on the test that might ask for components like this. You're not going to have to do an entire bank rec, but you're going to question, they're going to ask you maybe what goes on the bank side of the bank reconciliation. Just two things. You start with the balance of the bank. Well, our bank statement says we have $800 here, but we have deposits in transit that the bank does not know about. Those are checks from our customers that we've not put in the bank yet, but we've recorded it. We recorded it, but we're not going to take it to the bank until next week for some reason. Outstanding checks are checks we wrote that are still going to the bank, okay? So on the bank side, no journal entries are needed. Whatever numbers come out here, no journal entries are needed because this is us telling the bank stuff they don't know. Now we look at their bank statement and we find out a few things. We find out, whoa, a customer paid the bank directly. We didn't know about that. Bank charges some service fees or interest, a bounce check, an NSF check, boom, boom, boom. No good. We got paid by a customer and we recorded that as a debit to sales, right? And a credit to accounts receivable. And we thought we had that money. It turns out at the end of the month, we don't have it anymore. The bank found out the check was no good. All reconciling items on the book side require the journal entry. And I'll give you another hint. Every journal entry resulting from a bank statement is going to debit or credit cash, okay? And just we'll look at this bank statement briefly, because this is a review, not a full lecture here. So let's see what we got. We have a bank statement that says the bank has 9610. Our checkbook says 7430, and they give us some what are called reconciling items. Looks like we have some outstanding checks, and we have a deposit in transit, huh? Well, what's our template? We're going to take those items. We're going to take the bank balance. Oh, excuse me. We're going to take the bank balance, add the deposits in transit, and subtract the outstanding checks. And there we go. I'm ignoring the bank error deliberately. Okay. Now we have to look at the bank statement and figure out things that they're trying to tell us. Well, a customer's check bounced. We have to credit cash. We don't have the money anymore. Bank statement, $30 interest. So that's the debit to cash. And we have check number 781, where we apparently debited supplies, but we made a mistake. When the bank got the check, the bank was for $260. The bank saw that it was a $268 check, but somebody somehow, some way entered it into the system as $240. Again, let me emphasize the template, the picture. Bank balance plus deposits in transit minus outstanding checks. Whammo, you're done. Okay. The book balance begins with our general ledger balance, plus anything you see on that bank statement that we don't know about. And you come up with the two reconciling numbers. And get a peek at the journal entry here. Well, we saw the bank gave us $30 in interest. Wait, that's $30 more. We had that customer, that bum, who gave us a bad check, and then we understated the amount of the check. These two really should have been written in different journal entries. And the total is cash. Cash. And I'm not going to go through the metrics because we're going to start doing that in a week or so on the FSAs, okay? Any questions on that chapter, Brianna? Anything
No.
that's okay? So I'm using you as the what's the word I want? The stalking horse, I think they call. All right, hold on. So let's go to the next chapter. I think this is the hardest of the chapters, to be honest with you.
I do have a question that's kind of, you just said the FSA, we have one due Sunday.
No way. I saw that, but has Cornelia signed it to you? Has she given you information?
No, that's why I'm
No.
confused.
No, that's going to have to be pushed back.
Okay, thank you.
Usually, I meant to ask her about that the other day.
What? Yeah, I don't know. I haven't checked the email, but I thought we should receive some sort of information.
Well, you should get it from me, and she'll probably remind me that it was my responsibility to do that. But she usually kind of gets the ball rolling on that. But that's my bad, I think. So I'll speak to Cornelia a little bit later. You need at least a week to do that. Not that it takes a lot of time, but you don't want to be under that kind of pressure.
Yeah.
Oh. Great tell. What do we have here? Okay. Now, when we reviewed this a couple of weeks ago, you were pretty good with the depreciation, as I remember. Okay, depreciation. Long-lived assets, huh? Big things, big ticket items, tangible and intangible. Tangible, we can touch them. Intangible, intellectual property like patents and franchises and copyrights. And they're just showing you how it looks on the balance sheet. You're going to see all the original cost items, less the accumulated depreciation, gives you the net equipment, property and equipment, and then goodwill is another long-term asset. Remember that when you buy a fixed asset, any costs that you incur to bring that asset up to its full use is part of the cost of the asset. You might have to hire an electrician to wire it up. You might want to paint it in your colors. You might have to knock a door down to squeeze it in or something, okay? And they're just showing you a real shortcut on this slide here. They're just showing you different ways you can buy a plane, huh? Well, if you have $75 million, you can go to Boeing and say, I want that particular plane. So that's easy, flight equipment, credit, cash. But Southwest said, how about this? How about I give you a note? Will you trust me to pay you $74 million, say in 5 years? And Boeing said, yeah, we trust you. So here, they only had to put $1 million down and they will pay the balance of this note in 5 years. Of course, that's going to be a big chunk of interest they have to pay every year until the note matures. Or they offered Boeing stock. The stock was $50 a share, I believe, at this time in our book. And they said, look, we'll give you X amount of shares. So they gave them 1 million shares of par value stock. They put down 1/3 in cash and the balance additional paid in capital, okay? And you can also build your own fixed asset, like I said in the lesson 2 weeks ago where I worked. Our factory was destroyed in the earthquake, and we renovated a new building in Baldwin Park. Know the difference between a repair and an improvement. A repair, that's just the normal oil changes in your car. Maybe you have to have a tune-up once a year. Rotate the tires. Change the filters. Small items in cost that are done once in a while. But regularly you're going to, rotate the tires. So that's an expense. You would debit repairs or maintenance expense or something like that. But if you have a machine and you really improve it to the point where it's much more efficient and it extends the life of the machine and it's a big chunk of money, well, now you're talking about an improvement. And that fixed asset that you originally were depreciating $80,000 as the depreciable base, you spent 20 to really soup that thing up. So that's 20,000 that's going to be added to the cost of that machine. It gets capitalized, meaning it goes on your balance sheet. It's not an expense. You have to recalculate the depreciation. Yeah, this guy was a bum, Bernie Ebers at WorldCom. He's the guy who cheated by telling the world he had no expenses. All of his expenses he called capital items. How he got away with that for as long as he did, I don't know. Depreciation. We understand depreciation is an estimate, right? It's an allocation. It has nothing to do with the market value. With the market value, okay? Let me just move over here, Brianna, okay? Give me 1 second. No offense, Brianna, but I thought we'd have more people here today.
So too.
Cornelia, reminded me, don't forget you're reviewing. Okay, now I'm more comfortable. There we go. Perfect. Here we go. Hi, Bob. Okay, WorldCom. Oh, we don't want to talk about them anymore. Depreciation is an estimate. It's an allocation. And the depreciation expense is what goes on the income statement. The accumulated depreciation goes on the balance sheet. It's a contra asset account. Depreciation, cost allocation, the remaining balance sheet amount does not represent market value. It's almost impossible to match market value if you got a building and land. Look at the journal entry. It's always the same. It's debited depreciation expense and a credit to accumulated depreciation. So your assets go down every time you write this journal entry. What goes down is called the net book value. We bought that plane for $75 million, and that plane is going to last 10 years. So every year we're going to debit depreciation expense for $7.5 million and credit accumulated depreciation. Book value, net book value, just like you have net receivables. Book value is an approximation of the remaining life. Well, yes, we know that. Okay, now they're talking about the different methods. The calculation of depreciation. We need to know three things, right? We need to know how much we paid for the asset. We have to know how long, or at least be able to estimate systematically and rationally, how long that asset's going to last, and if there's any salvage value, because you don't depreciate the salvage value on two of our three methods, which are straight line, units of production, and declining balance. So here we go. We bought something for $62,500, and it has a scrap or residual value of 25. So that means we're only going to depreciate 60. And it's straight line, meaning it's just 3 years, so it'll be 1/3 a year, right? So every year we're going to be debiting depreciation expense for $20,000. $20,000. Okay. You notice these slides today don't have the grids, but I don't really think we need them for you guys. So that's pretty easy, right, Brianna? Straight line?
Yeah. Mm-hmm.
Units of
Yes.
production. Well, units of production, we don't care about years. We don't care about years. We care about, in this case, miles. This machine or whatever it is expected to travel 100,000 miles. And the depreciable value, again, is just the 60,000. So dollars per mile means divide the dollar 60,000 by 100,000, and you come up with 6 cents, 60 cents a mile. And here's your calculation. Oh, that's double declining. I'm sorry. Gee, I don't like the way they laid this out, but anyway, 60 cents a mile. How many miles did they drive the first year? Well, they told you that. They told you it was 30, 50, and 100. So once this machine or vehicle, whatever it is, gets up to 100,000 miles, it's fully depreciated. In both these methods, straight line and units of production, when you're finished with the depreciation, fully depreciated, the balance of the net book value will be the scrap value. Keeping in mind, you can never go below the scrap value with your net book value. Here we go. Declining balance method. What's the word I said you put in front of declining balance?
Double.
Double. Thank you. Double declining balance. Can you all remember that out there in 230 land? Call it double declining balance. Why? Because it's twice whatever the straight line rate would have been. Okay. Now, in this example here, we're depreciating this plane or whatever it was, this ground equipment for 3 years. Straight line, that was 1/3 a year, right? Under this method, doubling that gives you 2/3. That's not so hard. So every year, we're going to multiply the remaining book value or depreciable value by 2/3. So let's see what we have here. Well, there it is. 1/3 times 2 is 2/3. So look at the depreciation in the first year under the, oh, there they go. They got double declining balance up there. First time I've seen that. 62,000 is the amount we're going to work with here. In this method, you don't subtract the salvage value. A little bit of an outlier there, okay? So 2/3 times 62.5 gives you a whopping $41,667 worth of depreciation in the first year. So with this method, you're really front loading the depreciation expense. And companies make these decisions strategically. So that brings the net book value from 62 down to, I don't know, 20 something. And then you just multiply the remaining book value by that amount. And here's a look at, go ahead.
Going back to the previous slide, the one in the middle, is that like the first, like when you wouldn't accumulate, there's no accumulated depreciation. So is that the first year that you don't have any because you haven't?
Well, we're going to depreciate the whole 62.5. And what they're saying here is they're going to take the 62 and they're pointing out that you do not subtract the salvage value. That's what that zero means. Was that your question?
Yeah, I'm just saying the accumulated depreciation is for. Okay.
When you buy this machine, you have no accumulated depreciation until you start depreciating it. So what they're saying here, we bought this machine and it's going to be for 3 years. Double declining balance means, in this case, 2/3. And you go from there.
Okay.
That help?
Yeah, sorry. I froze for a second.
This thing's giving me Give me Ajda. Can you read those numbers?
Sort of.
Well, if you can't read them, I can't. Let me see. Maybe this works. Whoa! I'm like a magician. There we go. Didn't know I could do that. Okay, here we go. Now we're depreciating the whole 62.5 under double declining balance. So 62.5 times 2/3 is 41. 62.5 minus 41 is 28.33. 28.33 times 2/3 is this 13 number. And then you repeat it for the last year. And you're done. But you must keep in mind that you can never have the net book value go below the salvage value. So that $2,500 is what we want. And here we got 23.15. So we went below it by what? 23.50 by $185. So this number here needs to be reduced. And that's what I hope they show us on the next slide. They don't. The point is they stepped on this 46.29 with the 44.44. Okay. I think you were good with that too, right, Brianna?
Yeah, I just wanted to make sure because the first year you don't write the accumulated depreciation, you don't expense it to the first or the accumulated depreciation is 0 in this first year. So because it hasn't, the first year is when you
at the end of the first year is when you start depreciating. Yeah.
Yeah. So that's,
in the real world every month, of course, but yeah, at the end of the period.
Yeah. Okay.
We bought this thing December 31st, 2119. At the end of the year, then you start talking about the depreciation.
Yeah.
Alternate methods. And a little bit of talk about how managers choose. Asset impairment. I don't think we got into that really. So I'm gonna go skip that deliberately. Disposal of a piece of property, equipment. Companies have machinery out there. And maybe they decide to buy another machine. And they get rid of the old one. Well, they get rid of the old one. Maybe they take it to a landfill, or they have somebody buy it from them, in which case they may make a profit or suffer a loss. Okay. Now, for everybody out there in 230, the journal entry is always the same. Always the same. So let's go through what they're telling us here. Now, Southwest sold flight equipment for $11 million at the end of year 17. Okay. At the end of year 17, the flight equipment originally cost and they were depreciating for 25 years. So 30 million minus the depreciation through the 17th year gives you a book value. Or what are they asking for? Anyway, oh, the total depreciation expense. Okay. Are these numbers correct? This is what I hate. 17 times 3. We'll pretend these numbers are correct because the point is you must record. I'm going to skip these because I don't think they're helpful at this point. Okay. Here's where I wanted to go over in the review. Your journal entry is always these 4 accounts when you dispose of an asset. In this case here, somebody gave us $11 million for a piece of equipment that cost us $30 million. So we have to credit the original cost of the asset to get it off the general ledger. But we also have to remove the accumulated depreciation with a debit. So your entry is always the same with the disposal of a fixed asset. Turn this into a template. Cash, you know you're going to debit cash, and you know you're going to debit accumulated depreciation, and you know you're going to credit the original cost of the asset. So in this case, that resulted in a profit. To balance the journal entry here, this added up to 31.4. So we know on that basis, the profit or gain, I shouldn't say profit, the gain on the sale is $1.4 million. The gain on the sale equals the cash minus the net book value. The gain or loss is the difference between the cash and the net book value. Let's talk about intangible assets a little bit. Goodwill, trademarks, copyrights, huh? Intangible, huh? We amortize intangibles. We depreciate tangible fixed assets. We amortize intangibles, and we deplete natural resources. So let's talk about intangibles. And again, this is an allocation method, and there's some rules involved. Goodwill occurs when one company buys another. Let's just set that aside for now. Trademarks, the McDonald's logo, copyright. You wrote a bestseller just now. Only you can benefit from that. You've got the copyright on that. And they're showing you some others. Patents is the one we're going to talk about more. Now, let me point out that you earned a patent from the government. You invented a machine, okay? And the government said, yep, this is original, and you proved that you're the brains behind it. You have the patent. You do not put the patent on your balance sheet. It's not an asset to you in terms of the accounting. And the reason is because of the rules on research and development. It might have taken you 10 years to develop that machine, to fine tune it, to get all the bugs out of it, to get the government authorities approving it. All that R&D expense was expense. All of that R&D spending was expense. Therefore, you had a lot of benefits of tax breaks when you invented this. Now, this is rather a long-winded way of getting to my point. You invented the machine, but you have no desire to sell it or manufacture it yourself. So you sell me the patent. When I buy the patent from you, I debit patents. So the point is, patents only belong, accounting-wise, to the people who bought the patent from the patent holder. Talk a little bit about natural resources. Remember we did the units of production method with depreciation? Well, that's what we have here. The same thing. We're going to say that we had that truck, remember, that was going to drive 100,000 miles, and we multiplied per mile. Here, we're going to drill an oil well, and our geologists estimate there'll be 1 million barrels of oil coming out of that. Well, we figure out the cost of building that oil well and divide it out to get the cost per barrel. And that would become our journal entry. These slides are really truncated and less detailed. Any questions on this, Brianna? You think you're good if they ask you to come up with the gain on the sale of a fixed asset?
I think so.
Yeah, that's a little tricky. The 3 depreciation methods are kind of easy, I guess, huh? Straight line's easy. You already learned that. Units of production. They have to tell you how many miles, or if it's a machine, how many punches, or how many cans this thing can stamp out. And then when you know the actual, you just multiply it by the rate per can or mile. Okay. Now, it looks like we went from chapter 6 to chapter 8. You ready for chapter 7?
Sure.
Chapter 7. Chapter 1. Chapter 7. Chapter 7 is all about inventory, huh? Cost of sales.
Yes.
I happen to think this chapter is rather interesting. Well, they're just showing you two new terms that we haven't really touched too much. Cost of goods sold. That's an expense representing what you paid for the item you just sold. Harley Davidson sold $5 million worth of motorcycles that cost them $3 million to build, is what we're saying here. Inventory is a current asset, huh? Don't worry about material, labor, and overhead. Just like a fixed asset, inventory sometimes have ancillary costs, such as freight in. Maybe we need to inspect the stuff. Flow of inventory costs. Don't worry about the bottom. That's for 240. I mean, it's pretty simple. We purchase merchandise and we add it to our inventory. And when we sell it, we credit the inventory and debit cost of goods sold. And hopefully we sold it for more than that. So make sure we're all comfortable with this template, okay? Because this is a big part of the chapter. Beginning inventory in units and dollars, plus the purchases made throughout the month equal what we're going to call goods available for sale. You have a bookstore. At the beginning of the month, you had 1,000 books in your store. And then during the month, you bought 14,000 more books. So the most you could have sold, meaning what was available, was 15,000 books. At the end of the month, you went out and you counted the number of books left. You had 2,000 left. That means you sold 13,000. And that's how we're going to compute the cost of goods sold under a couple different methods. Now, right now, we're teaching the entries required in what's called a periodic system. It simply means that when you sell something, you don't record the cost of goods sold at the point of sale. You have to wait till the end of the month to count the inventory and back into the number. Okay? What are our four methods? LIFO, average cost, specific ID. Okay. Please remember, everybody, the total goods available for sale is the same for all methods. That's your starting point. That's your beginning inventory plus what you purchased during the month. So what these methods do is take that available and figure out how much of it belongs in the inventory and how much of it you sold, okay? And again, none of these methods have anything to do with the physical cost. Mesa Produce, I told you, they opened up after World War II. They use LIFO. That means they still have the first banana they bought back in 1947. Of course, they don't have that first banana, but they're allowed to pretend they do for purposes of LIFO. This is a good grid. I don't think we need to spend too much time on this. Here, you had 2 units to begin. So that's 70, 70. And then you purchased 4 during the month for 80. And then you bought 1 more for 100. And they're telling you they sold 3. They sold 3. So under FIFO, which ones did we sell here, Brianna?
The first in.
Yeah. So we sold these 2, right? and these two. We sold 4. Up here is the inventory. Yeah, you start at the bottom here. Okay, we sold 4 items. 1, 2, 3, 4. 80, 80, 70, 70. That's your cost of goods sold. The available was 560. You just subtract that and get the 260. You don't have to calculate both the inventory at month end and the cost of sales. If you get one, you just subtract it from the goods available, and that'll give you the counterpart. If you know the ending inventory, subtract it from cost of goods available, you get cost of goods sold, vice versa. And I'll give you a little Bob tip. Look at the problem and read it for a few extra seconds. If they're asking you to calculate, say, like this one does, the cost of goods sold, and they're telling you they sold 10,000 units and they had a whole bunch of purchases, maybe it would be easier to do the ending inventory, since in this problem there's only 10 in the ending inventory in the problem I'm making up. Okay. Divide and conquer, huh? First in, first out. Here we go. First in, first out. Goods available for sale. Everything is the same here, right? And here we go. What did they sell? They sold 2 units at 70 and 2 at 80. So your cost of goods sold is 300. This is 260. It might have been easier to work with the ending inventory of 3. You could have started the other way. LIFO. LIFO, last in, first out. We're always selling the newer items first, the more expensive ones. So here, we sold 4 items, right? And where did we get these, Brianna?
Where do we get?
LIFO.
The last ones you brought in are the first ones out. So
Yeah, so that would be this one here, right? 100.
Yeah.
Plus 3 of these guys. So notice you came up with a different cost of sales number and a different inventory number. And here they're going to take us, they're again reminding us, which is good, that the total cost of goods available is always the same. And here's their calculation. So here we're looking at cost of goods sold 340. The average cost method is the super easy one. Super easy. We're going to get the average cost from the goods available for sale line. 560 divided by 7 is $80 per item. $80 per item. So all you do is figure out we sold 4 times 80, and we still have 3 times 80. Don't make this mistake I've seen students make. Remember, you divide the total, all you need is the available line, 560 divided by 7. Some students do this. They go, oh, they want the average. Bob said it's average costing. Okay, this is the average cost. 70 and 80 is 150, plus 100 is 250. You divide that by 3, you're not going to get 80. You're going to get 83 or something. The only way that works vertically is if the units are the same, okay? Average cost method. And they didn't show us anything with specific ID, but that's an easy one too, I'm going to suggest, because they tell you exactly which ones were sold. Specific ID method is the method that does represent the physical goods of the product. You buy a car at Perry Lincoln and you tell him you want to buy a Thunderbird or something. He doesn't say to you, go out and pick any Thunderbird you want out of that row. It's yours. No, they have to keep careful track, specific ID. Keep in mind that the questions we ask about FIFO and LIFO assume a normal economy where prices are rising. Okay? The reason I say that is you're going to get questions along the lines of which method gives you a higher net income. And the answer is FIFO will give you a higher net income because your cost of goods sold will be lower. Under FIFO, you are selling the old cheap stuff first. FIFO, what are you selling? 70, 70, 80, 80, 300. This is LIFO, $340. This is LIFO, forgive me. 100 plus 3. Cost of goods sold under LIFO will be higher than that of FIFO. You need to know it because that usually comes up on the test in various sneaky ways. The average method is going to obviously fall in between, and the specific ID is unpredictable. That could be a real outlier. So let's see here. Perpetuals. Okay, well, take a look at it here. This is a good look at it. FIFO, net income was 75. Wow, it was only 45 for LIFO. And like we figured, the average net income is in between. Now, companies will choose LIFO perhaps because they saved themselves $30 here, the difference between these numbers, in taxable income. This company has to pay tax on 75, and this one has to pay tax on 45. So let's assume these are real big companies. You know, that difference is $30 million. Let's assume a 30% tax rate. This company saved $9 million in cash compared to these guys. Now, why would this company choose FIFO? Maybe because they want to make a big splash. They want to put out a press release that says, we had record net income. Aren't we great? In the hopes that people pay more attention to their company, buy their products, and probably most importantly, goose the price of the stock. Okay, so there's strategies involved in choosing these methods. But FIFO, higher net income. And again, that's in a paradigm of rising prices. Prices are falling, it's the opposite. We don't teach that in our 230 group here, other professors do. We're glass half filled kind of people. A normal economy has to have some inflation, not crazy inflation like when I was in school, what they call runaway inflation, but you have to have some. People have to earn more and more money as they progress in their career, and people should be able to sell their product. And we're not going to get into this. Okay, here's a little thing on why they prefer. Managers maybe prefer to show higher earnings. They would go for FIFO. LIFO if you want to cut your taxes down. LIFO conformity rule, I don't think we have to worry about that. That's a tax issue. And maybe many of you will take Professor Barbara Aue's tax class, which is an excellent course. I guess this is about the last thing to review. Lower of cost or market. You bought a bunch of shirts a year ago, and you paid $20 for each t-shirt, and you've been selling them for $30, and you're selling them, and after a while you don't sell too many, and then suddenly the sales seem to almost stop. Salesman comes into your office and says, these $20 sweatshirts, our competitors are selling them for $15. No one's going to pay us $20. You have to recognize that loss of $5 immediately per shirt. That's all. The lower of cost or market says the lower of cost or market is the value of your inventory at all times. So here we go. Net realizable value when it goes below cost. And here's a nice, simple, clear look at the concept. This company purchased 1,000 Intel chips for which they paid $250. Well, the problem is they bought way too many because the technology got ahead of them, and now people can buy those same chips for $200. No one's gonna buy these chips for 250. They're gonna have to sell them for 200. So we must recognize this loss of $50 times 1,000. That's a $50,000 loss. Let's look at the second one. They bought disk drives and they paid 100, and they're still getting 110. So no adjustment is needed there. Which was lower, 100 or 110? Cost was lower. Here, market was lower. So this inventory has to be written down by $50,000. Disk drives, the lower was the 100, so that doesn't change anything. And then we'll get into the turnovers another time. Okay, Brianna, what do you think, huh? We went through 3 chapters somewhat quickly. I did want to hit those high points, though. I would recommend to everybody you do this. Write a T account for the allowance. And on the debit side, put down accounts receivable. On the credit side, write bad debts expense. Because those are the only opposites of that transaction. Okay?
All right. No, I think I'll do the practice and hopefully you have tutoring tonight at 5.
I certainly do. I brought my 4-year-old grandnephew into the Zoom meeting for 5 minutes yesterday. That was kind of funny. Yeah, he happened to contact me and his father, and he was like the 3rd smartest kid in the group, I think, but it worked out good. Okay, Brianna?
Okay, just also to clarify, if you could talk to Cornelia about
The FSA, yeah.
Yeah, because the email says that that it's due with our discussion on Sunday.
I'm going to contact her right now.
Okay.
And let her know. And also, in Tuesday's class, before we get into chapter 9, I'll spend time showing everybody how to put that together. Okay.
Perfect. All right.
All right.
Thank you.
Okay.
And
good night. Have a good one. Maybe
you
sleep
too.
tonight, huh? Bye-bye.